Welcome everyone to the fourth and final session of the Google for Startups Immersion program, powered by Antler India. Over the last 3 sessions, we have been deep in the trenches of Code Zero building architectures, deploying autonomous agents, and scaling serverless pipelines. But today, we are shifting gears. We are moving away from the stack to focus entirely on the business, economics, and the capital strategy of your startup. I'm Anshul Tibrewala, Marketing Director at Antler India, and I'll be your host for today's masterclass. Here is the hard truth. Building a highly capable, cutting-edge AI product does not automatically mean you have a venture-backed business. Today, we're stripping away the LinkedIn hype around fundraising to focus on the raw mechanics of VC math. We are going to look at fund dynamics, required growth trajectories, and the exact frameworks you need to objectively evaluate if and when your startup should pursue venture capital. To pull back the curtain, this session is being led by Nitin Sharma, partner at Antler India. Nitin is here to give you an unfiltered, completely transparent look into how institutional investors evaluate the AI ecosystem today. Before I hand over the mic, let's set some quick ground rules to keep today's session high signal and high impact. The Q&A box. We have a dedicated team monitoring the Q&A box live, filtering the best questions to bring to the stage. Pro tip: if your question is highly specific to your unique setup, it might not make it to the main stage. Frame your questions broader so they offer value to the entire cohort. The main chat. Ragini and members of the Antler team will be hanging out in the main chat room for real-time follow-ups. Let's keep the conversation helpful, friendly, and collaborative. Strictly no spam. Please refrain from dropping LinkedIn profile links or WhatsApp group invites. Our moderators will actively remove them. Let's keep this space purely dedicated to learning. Interactive breaks. We will have 3 dedicated Q&A breaks throughout the masterclass where Nitin will answer your questions live, so keep them coming. With that, let's kick off our final masterclass. Nitin, over to you.
Hi everyone, welcome to this special last edition in the Google Immersion with Antler India series. Really excited that it's received such a massive turnout as a reception across the country. I want to start by thanking Google for Startups. It is testament to the massive reach of Google and the commitment that they have to helping founders all over the country, which is why we are so proud to partner with them and to bring this content to you. What is today's session about? So I think you've done 3 amazing workshops about actual building with the cutting edge stack that exists today. As Anshul mentioned, I'm going to take you into a very different realm for the next 90 minutes. And this is about VC math and venture scalability. So what does this mean? Well, the workshop that I'm going to take you through today has actually been now received by close to 2,000 founders in 8 different iterations of this. And this is usually what we do in the Antler residency when founders come to us and work with us to create their companies and launch something from day one. And it's been received well enough that I felt this is content that we would love to share more broadly with the ecosystem. Now, what is the reason that we built this workshop? I think the first thing that struck me was there is so much content about how to pitch, how to raise money. There is so much coverage about any startup that raises money. But at the same time, there is very little understanding of the mindset that a VC has. VCs love to tell startups and founders that you should understand your customer. Well, when you're out starting your company and you need the capital, the source of that capital, it could be the VC firm, is also a customer. It is also a stakeholder in your journey. And yet, you don't actually think about what's going on in their mind, right? So this is the reason why we created this workshop, is to actually walk you through the mindset of the VC so that you have the right mindset in terms of knowing, is your business venture scalable, and what you should pay attention to realize it is venture scalable or not. And I think the other part of this is the understanding that venture capital itself is a very strange asset class, right? What is venture capital? At the end of the day, this was an industry created to take the biggest amount of risk, the largest risks, in ideas that you could not underwrite or fund through conventional means, right? So if you are a rich person and you have properties, you can always leverage against that. A bank can give you a loan. If you're starting a manufacturing business, there are assets, you can use bank loans, very many other kinds of debt financing. But what happens when you just have an idea? Or what happens when you have a completely new technology? This is the essence of why venture capital was started. Now, which means that it is only a good fit for certain types of ideas and certain types of founders, right? Unfortunately, in India especially, we have created this aura that if you are receiving VC funding, you're a great business. If you're not, you're not a great business. And nothing could be further from the truth. And that's actually the first point I wanted to mention today, is that do not assume that venture is the only way to build a company. We are going to go through the kinds of companies that venture capital is good for. So, as I said, we'll focus on the mindset. The crux of today's discussion is the VC is your customer. What pressures is he or she under? Who is VC right for, and who is right for VC? And one of the most common things, I'm sure every one of you in the audience, maybe you have pitched yourself to VCs, or have friends who've done it. The most common refrain in the entire industry is, VCs don't understand my business. I got rejected. What is wrong with them? Are they stupid? They don't take risks correctly. Because this is a business where 95, 99% of the people do get rejected, right? So, it is what it is. And I think instead of worrying about, the rejection, I think there's always a good lesson in why a VC has rejected you, and yet not being affected by it. So what I hope you will get out of this session by the end is, if you have already gone through the VC process, a better appreciation of why you may have been rejected, perhaps. What this discussion is not about today is the tactics, right? I'm going to focus on the mindset, which I think is the most important thing. The actual tactics of how you create a pitch deck, what you put on a slide, how you follow a CRM process to approach the VC market, etc. I think those are important topics, and there is a lot of great content online on that. That is not something that I will go much into. We can have perhaps some Q&A if that's of interest. And again, before I kick off, I would say every startup is unique. Nothing I say will be without exceptions. So please don't think that my advice or my comments apply to every single situation. VCs are wrong all the time. This is a strange industry where you can be wrong 95% of the time and people still think you are successful. And like I said in the beginning, you can be successful without venture funding, especially in the new age of AI. Certain types of businesses will need VC funding more and more as distribution becomes very, very important and speed becomes very, very important. But some other types of businesses may actually do fine without venture because the costs of building and launching have come down. So there is this weird dichotomy which we will unpack. Just to give you a little bit of my journey and why I feel I have now earned enough experience and gray hair to talk to you about this topic. I've done 15 years in global venture capital in India and the US. My journey started at a very large established fund, after which I worked for a smaller fund, was part of the founding team of a fund in India, then ran my own micro VC, and now I'm building Antler India with my team into a very exciting, leading first check platform. We are now probably the largest global platform that's present in India, writing the first check, being the first believer in founders like you. In these 15 years, I've seen something like 20,000 pitch decks and done more than 8,000 meetings. Had a number of successes, more than 17 companies that crossed 100 millions, bunch of unicorns. But the biggest learnings have come because I've also seen a lot of failure, lots of co-founder conflicts, lots of rounds that take forever. So if you've struggled in any step of raising money, just understand you're not alone. Even the well-funded founders struggle. Okay, let's kick it off. So, as I said, the first premise is, if you are going to talk to a VC, just like you would talk to any customer of your service or product you're creating, let's understand that audience. Okay, so just like there are laws in physics, there are a few things which are very true about VC which rarely get talked about. And so I'm going to go through a few lessons I've learned. So, number one, For those of you mathematically inclined, and I'm sure given it's a Google Startups program, there are lots of you who remember your statistics or math. You might remember the power law. It's a specific distribution. Venture capital operates with power laws, what does that mean? It means that it just comes down to a few investments that really matter. SpaceX is going public this week. The gains that some investors will make on that one company will be bigger than the gains they have made in everything they've ever done in their career. And so this is something which is really, really important to understand, because this is how the VC decision making starts. So let's look at some charts. So this is a distribution, this is data from the US, not very old, slightly dated 2022, but I think if you updated it, it would still look the same or even sharper because of AI. What this tells you is, if you look at 35,000 different financings, companies that got funded in the US over the last decade, half of them, right, almost 48%, roughly half, have lost money, right, which is the bar you see on the very left. Some of them, 27% of them, make between 1 and 3 times for the VC. So if they invested $1, they are going to earn $1 to $3. And if you look at the fact that this took 10 years, it's not a great return. And some of them may still go out of business, right? So bottom line is something between 50% to 2/3 of the companies that a VC typically invests in at the early stage, at the stage at which most of you are, the VCs will lose money. Now, that's a very humbling statistic, right? Because every founder believes that their company is special and the VCs will make a lot of money, and they will hopefully make a lot of money as a founder. Every VC wants to believe that every company they have backed is special and they will make money. But then life happens. Lots of things can go wrong. Markets change, technologies change, business models change. And for many, many reasons, companies don't succeed, right? So now the good news is that if you look at the other end of this chart, there are 3% of companies which return more than 20 times the money that was invested in them, right? And then within them, of course, you can look at what Google was back in the day or what SpaceX or Anthropic are today. You find within them, right, certain investments are not just 20x, they are 1000x, something like that. So this is the power law. Basically the notion that you will invest in lots of things, but ultimately only a few investments will determine everything in terms of your returns, right? So hopefully that's point number one, which is internalized. And this is another way to look at the same data. This is from Andreessen Horowitz. And this says 6% of deals produce 60% of returns, half lose money. Very similar conclusions, just a different data set. So that's one. Number two, great funds versus average funds. So if I were to ask you, let's say you believe some fund globally is a great fund, and I ask you, if they invest in 100 companies and a fund that's still not great but is average, they invest in 100 companies, who will get it wrong more often? The most common answer will be, well, of course, the average fund will get it wrong more often, right? They will lose money more often. Actually, it's the opposite. The great funds know that they actually are wrong more often. So if you look at the data, again, this is from Andreessen, if you look at the top funds, it's not that they have fewer misses, they actually take bigger risks, right? So the funds that really are exceptional, they take more and more risks. They want the outcomes to be bigger. They care not about, hey, I might lose money. They care about if it is one of those 3% deals, right, that I mentioned in the previous slide, is this going to be big enough? So this is something which a lot of founders don't understand when they approach VCs, that the good early stage VCs are not trying to avoid the risk. They don't mind losing the money. They are trying to not minimize the risk or the downside. They are trying to maximize the upside. So what matters is are you showing them a story such that if you are successful, is the outcome big enough? Right? This is a very, very common mistake I've seen where founders start to feel conscious. They have to explain, look, this is de-risked, this is de-risked. It's not about what is de-risked. It's about, I will take the risk as an investor, but are you pursuing something that will be massive if you are successful, right? So this is the second sort of lesson that I would like to share with you. And this is data that also corroborates the same point, which is for the great funds, their big hits are making almost 70 times the money on average, versus the good funds, their big hits are making 27 times, right? So again, it's more about the size of the biggest hits. And if you have followed baseball, this is called the Babe Ruth effect, which is you just have to swing for grand slams or home runs, right? You don't play safe. You want to take the risks. Is the outcome big enough is the only thing that you care about. Now, third point I would like to share with you is that, and this is a little bit less important, but if you are talking to a customer, you want to understand how they think about making money in their own careers, right? If you sell to a customer, you are trying to understand ROI, that why are they paying you X amount, right? So similarly, one thing that I wanted to dispel, there's a notion that VCs just make a lot of money. Well, unfortunately, I can tell you this is not that true. The very large funds, of course, have different economics, but for most early stage funds, they only make serious money when they have real outperformance. So only when they are in the top 25%, top quartile, is when they make serious money, right? And there is some interesting data here. And again, I won't bore you with this. This is more for those who are interested in finance. But you can think of, money can be invested in the stock market, in real estate, and there are lots of different investors who manage these assets, right? If you are in the top 25% of VC funds, you make a lot of money. You make returns, which you can see here are over a 5-year period, 48%, 38% over a 10-year period, right? So if you put money in a fixed deposit, that's less than 10%. But the top venture funds are performing at almost 40%. So when you compound it, that's crazy, right? That's a huge multiple. But this is only true for the top funds, right? For a lot of the other funds, they actually underperform. So in this chart, what you can see is that the bars that you see, right, for different other assets is the difference between the good and the great. So that's the difference between the 25th percentile and the 75th percentile, right? And all this is saying is simply, you don't have to be overwhelmed by this data. All this is saying is, in other asset classes, when people are managing stock portfolios, real estate, the difference between the good and great is quite limited, right? But in VC, you see that bar, which is the shaded light orange bar. The difference is so wide. So if you are not a great VC, you are really underperforming. So what does this mean? Your customer is trying to, number one, they know the power law, so they want big outcomes. They want to be exceptional in their industry, so they want big outcomes, right? And they know the data from what has happened with good funds and bad funds. So the point is, it comes down again and again to making sure that the VC is seeing a very big story in your pitch. Now, another thing, the person you're talking to is a human being. I have raised a VC fund, and I can tell you it is really hard to raise venture money. Now, what does that mean? Founders raising money from VCs is very hard itself. But have you ever wondered where that money comes from, right? So this is how it works. If you are one of the companies that a VC fund invests in, you're part of that investment portfolio, right? So the VC fund is 1, 2, 3, 4, 5 various investments. That fund itself is raised from a variety of people who are called the limited partners, LPs. And the people who are running the fund are called general partners, GPs. Okay. Now the money that comes, so we Antler India, for example, have a $75 million fund to focus on the first checks in India. This has come from 180 different people or entities. We have, university endowments, charities, professional pension funds, rich individuals, their family offices, corporations, and the government of India, right? A variety of sources. So one of the things that's beautiful about venture capital is that the money that VCs are managing sometimes comes from these very important pools of capital, right? And if the VCs do well, it goes back to them. So for example, there may be a cancer research endowment, right, that is actually investing in cancer research, and they take part of their money or a university, for example, and park it in venture funds. So if we do well, if the founders we invest in do well, and hence we return a lot of money, a lot of profit, that helps cancer research, right? So there is a whole background here which founders don't really understand. So the VC is going to raise this money from a variety of people, and then they're going to deploy it in individual companies, right? So now that's clear, I want to tell you, it is bloody hard for VCs to raise these funds. Now, let's imagine why that could be the case, right? So when you come to a VC, you may come with at least a prototype, or you may have a product. Sometimes you may even have users. You may have a business plan. So you have something that you're trying to raise the money based off of. But when a venture capitalist is going to raise the fund itself from various limited partners, what do they have? At that point, they have nothing, right? So imagine I'm talking to you, and each of you in the audience, let's say you are a very, very rich person. Okay, I hope all of you are very rich by the end of this decade. And let's say that you have $100 million. And you could invest that money in lots of places, right? You could buy real estate, you could invest in the stock market, you could buy Bitcoin, you could buy gold. And you might say, okay, 1 or 2% of this, maybe I should invest in a VC fund or in startups. And so I come to you and I tell you, great to meet you. We have this amazing platform called Antler India. We would love to have you invest $1 million in our fund. And you're going to ask me, where will you invest this money? Now, guess what? At that point, we haven't even identified the founders, right? We haven't even met them. So I will say to you, well, you should trust our experience and our brand. In the next 3 or 4 years, we will find lots of amazing founders and we will invest in the best of them. You might ask me which spaces, which ideas. I may tell you, I don't know, because AI is still emerging on the application layer. We are figuring out which companies can be very valuable. We are working on the thesis, and this will change every few months anyway, right? So I cannot tell you where I will invest your money, and I cannot even tell you which ideas I will invest in, right? So I don't know who I will invest in. And then you might ask me, okay, how many of these will fail? Well, if I'm honest with you, I will tell you that probably 50 to 70% might fail. Remember the data in the first slide, right? And so, okay, so you don't know where you're investing my money. I have to give you this money and a lot of this might fail. Okay, so are you guaranteeing me any return? And guess what? Of course, you know the answer. There is no way I can guarantee you any return, right? So I have to invest this money and we have to wait for to see how these companies perform. So there is no guaranteed return like in a bank account. And then you might ask me, is my money liquid? Can I take it back at any point? Well, guess what? No. You have to lock it in for 10 years. Typically, a venture fund is 10 years. Because we will take your money, we will invest in these startups, then we will wait for them to get to the next stages. At some point, we will exit and give you the money back. Right? So far sounds great, right? I'm sure you're all dying to invest in venture funds. And then you might ask me, well, okay, so you don't know where my money will go. You don't know who you will invest in, which ideas. You are saying most of them will fail. You don't guarantee any return. and it's locked up for 10 years. So you cannot charge me fees, right? And guess what? Of course I have to charge you fees, because that's how we pay for the expenses of everything we do. Office, travel, programs, residencies, etc. And then you might ask me, okay, fine, I'll also pay fees. So typically a venture fund might charge 2% over 10 years. So 20% of your money will actually go to fees, right? And only 80% will actually go into startups. You might say, well, that's fine, but I don't think you will take a profit share, right? And you know the answer. Of course I will take a profit share, because that is the incentive for our team to do really well and create wealth, right? So I think you get the drift. Venture capital itself is a very, very, it's typically very hard for funds, new funds especially, to raise money. Yet, of course, billions of dollars get raised. So why am I going through this? I'm going through this to make you aware that if you invest after all of this that I've gone through, right? If you invest in Antler India or you invest in any venture fund, why would you invest despite all of these challenges? It's because you are expecting a very high return. So you are not investing in venture capital thinking it will be a 2x or it will give you 15% versus 8% in a bank account. That's not enough. You might invest in venture capital because you believe that the venture capital firm could not just double your money, but they might 5 times or 10 times your money, right? For 5 or 10x to happen, you probably are expecting that your money will multiply at 35-40% annualized after all the expenses, okay? So why is this important? Is because now you can understand what your customer is going through, right? When you raise money from the venture capital investor, this is the pressure that they are under. These are the expectations that their investors have from them, right? So then we can kind of make sense and say, it only will make sense to the VC to invest in my company if I have a really, really big vision or an outcome that can be very, very large, right? Okay, so I know I've gone through some 3 or 4 very, at least in my opinion, ideas that are not discussed enough in the venture ecosystem, and most founders are not aware of what goes on in the background of the venture firm. I wanted to see if we have any questions. Okay, we have a lot of questions. I'll take a couple. Abhishek Avalkar is asking how early stage VCs evaluate the gross margin profiles of agentic AI startups given the variable costs of LLM inference. Okay, that's very specific. Let me come to that a little bit later. When you look back at your best performing investments, what signals typically appeared much earlier than the market in India or the US recognized? And Shaunak asks, the second question was by Anubhav, and Shaunak asks, what is the sign of an outlier in the eyes of the VC? Okay. So this is a very tough question to ask in a short, to answer in a short answer, but I think that, Shaunak, to your question, within Antler India, we have something called AGOATX, AGOATX, right? What does that mean? It stands for audacity, grit, obsession, agency, thinking clarity, and sometimes there is also an X factor, right? So I would say that the first sign, I just tweeted yesterday that we made an investment in a company called Bazaar Now, which is a quick commerce model for smaller cities. And I felt that in about 15 minutes, I knew I wanted to invest. And that's true, actually. And the reason is the level of obsession and the detail that the founder was able to go into. I was very quickly convinced that this person is obsessed. They are thinking about every little detail that their customer will go through, that they are not able to sit still. They think about this over weekends, over nights. They are obsessed about solving this problem. And I know that's not the most straightforward answer. It's something that only when you talk to a founder like that, you can kind of tell, right? So it starts from that kind of an obsession. I think if you don't have that kind of an obsession for the problem, it's very hard to sustain the kind of energy you need for 5-10 years to actually create a large venture outcome, right? So there are, of course, many other factors which I talked about. Audacity has to do with not just a slide which says I have a lot of ambition, but what are those founders doing on a day-to-day basis, right? Are they audacious? Are they talking to customers that you would not think that they would even be able to talk to? Are they trying to hire someone way better than them, right? Are they actually fearless in the way they're making decisions? Grit has to do with, can they survive this for 10 years, right? Startups are really hard. And so the only reason I think people are able to survive is because they really believe in what they're doing. And so we spend a lot of time trying to understand the why. Why are you trying to be a founder? Why do you want to put yourself through this kind of pain? Why will you do this for 5 years? When everything goes wrong, why will you still keep doing it, right? And so on. And I think, agency has to do with, can they get stuff done? A lot of people are great thinkers, planners, but they cannot execute, right? They cannot get stuff done at the speed, and especially with AI startups, agency, being nimble and being fast has become very, very important, right? And then there is thinking clarity, the T in the AGOT X, right? Thinking clarity to me is, in my experience, the best founders are clear thinkers. It doesn't mean that they have all the answers, but they are clear about cutting down complexity. They know what to focus on, and they don't keep adding more things to the plate because, you've heard this perhaps, startups don't die of starvation, they die of indigestion, right? They take on too many things. So the best founders are very clear about what problem they are solving, what is step 1, what is step 2, and so on. Of course, these things evolve as they get more feedback from the market. So, Anubhav, I think I'll answer parts of your question in my next section as well. Okay, I think we can continue to the next part of it. All right, so now that I walked you through the mindset of what's going on in the VC's world, hopefully you can see, right, that if you are talking to a VC, they are trying to manage a fund and hopefully return 5 to 10 times. This is very rare. Most funds are able to return more like 2 to 3 times. But of course, they want to return 5 to 10 times, right? In a 7 to 10 year period, which means that if you calculate, that's an IRR or basically a return of 30 to 50% annual, right? Now, this they have to do accounting for the fact that many startups will not work out. There's a lack of predictability, right? So if you are doing an agentic AI startup right now, and you come to me and there's some early data you have from one customer, do I know that another customer will see the same value? I don't. If you have a dating app which has some early traction, I don't know how well it will translate to other markets, to other types of customers, right? So there's a lot of lack of predictability, right? And then, of course, there's a lot of change that happens. Before Gen AI came in 2022, before LLMs, I mean, there were so many types of startups which are completely irrelevant suddenly, right? I can give you a long list of examples. Right now, IT services, people are worried that, India's IT services industry is currently facing some headwinds. So there are lots of things that can go wrong, and you still have to try to generate a 5 to 10x, right? So that's your customer. They are trying to look at you and say, could this investment be a fund returner after my dilution? So what do I mean by that? So let's take an example. So let's say you have a 100 million fund, and I'll keep things super simple, okay? Let's just say you put $2 million in 50 companies, all right? And again, hypothetically, you took 20% ownership in those companies, okay? Now, what will happen is, as you know, over time, the VC will get diluted. So initially, you might start with 20, but by the time the company is successful, if it is successful, you might get diluted down to 5%, right? So let's do the simple math, right? Everyone here is great at arithmetic. So if you have 100 million fund and you are invested in these companies, and let's say most of them fail and one of them succeeds, now you just to return the 100 million, right? What do you think that one company needs to be worth? Now, simple math, right? If you own 5% of that company once you exit, and you have to, that 5% should be worth 100 million. That means that company should be worth $2 billion. If that company is worth $2 billion and I own 5%, I can then return the money that I was supposed to return. But of course, the LP did not give me the money just to get a return of 1 times. They are hoping 5 or 10 times, right? So this is why the venture math is so hard, and especially in India, because you actually need many such companies, or you need even bigger outcomes, right? So if that company can be worth $10 billion, then 5% will be 5 times my fund. So hence, what am I trying to do? I'm trying to find companies that can be that large so that I can return this kind of a fund, right? So of course, there are lots of nuances to this. I'm oversimplifying a little bit, but you get the idea, right? So, so this is the challenge that you have when you are talking to the venture investor, right? So to get a 5x kind of return, they are trying to make sure that on investing in your company, can they make 100 times that money in the first or second check? When they invest, let's say $1 million, can that be worth $100 million? That's the kind of thinking going on in the back of their mind, right? Now, of course, some VCs may have different benchmarks, and you could, for different kinds of businesses, you could apply different metrics. But especially for AI startups, if anything, this is even more so now the case that people are looking for bigger and bigger outcomes, right? The power law that I mentioned, AI is actually making it even stronger. So, and you've seen the headlines, whether you look at the market caps of the leading companies in AI and the amount of growth that is happening so fast, right? The power law is getting even more powerful. So, to sum it up, unfortunately or fortunately, the VC model requires that you are a big outcome relatively fast. Why do I mean relatively fast? In India especially, most companies that have become large have taken 15 to 20 years minimum, right? A Reliance probably took 20, 30 years to be a very large multi-billion-dollar company. And you can take many other examples like that. But in the VC model, because these are 10-year funds, you're actually thinking, the VC fund is thinking, can this be large? That's one, right? Which I already went over in the last half an hour. But also, can you be large fast? Because I need to return this capital within my fund cycle, which is 10 years. So if a VC fund invests in the 3rd year of their fund, they have 7 more years to return the capital. So then they are taking a bet to say, I invest in this person's company. In 7 years, can I see a great return? Can this be worth $1, $2, $3 billion? And can I return that kind of multiple? Right? Which means big outcomes means you have to get to scale. Fast, of course, means you have to get to speed. So this is why the way to think about whether you're right for venture capital is, can your business be completely non-linear in the growth curve, right? Now, non-linearity is not easy. Most businesses are not non-linear, right? Most businesses are, okay, you put more money to work, you have more employees, you have more sales, you have more products, and so on. But some businesses, of course, can be very, very non-linear, and that's what creates the best venture outcomes. Sometimes it's a function of the core technology, right? So when Google came out with PageRank, it wasn't the first search engine, but PageRank just was so much better as an algorithm than how it was being done elsewhere. SpaceX wasn't the first company to be in space, but they brought the launch costs down by a crazy factor. Crypto, when it came onto the scene, was a very elegant way of solving the double spending problem, such that you could transfer money or any value from A to B without the need for a bank in the middle, right? So sometimes it's beautiful technology. Sometimes it's that you are disrupting some chain, right? So before Amazon, you had sellers and buyers, but you could only reach the seller in your hometown and vice versa. And with something like Amazon, you get rid of the middlemen and sellers can reach buyers anywhere. Before YouTube, not everyone could be a content producer. Today, anybody can be a content producer. Sometimes it's a matter of very efficient, high frequency use cases, right? Uber, when it started, people thought this is, my favorite example of market sizing, right? People asked, hey, what is Uber's market size? And some VCs estimated that it was about $50 million because they said, what is the size of the black car market in San Francisco? So they did the numbers and they said, oh, this will never be a big business because, $50 million is the market. But is that how we think about Uber's market today? Not at all, right? Uber's market today, they will define is probably, the movement of any person or any goods anywhere. Now that doesn't seem like a 50 million market. It seems like a multi-trillion dollar market, right? Google's mission again was, to organize the world's information, right? So I think sometimes when you create a habit or the addiction, a new behavior, for example, with search with Google or getting into a cab with Uber or, doing a Claude search today, or Claude code, development, it's just high frequency, more efficient. Sometimes it's about the product experience itself being so much better. Apple, of course, is seen as a gold standard here. Developers love documentation that Stripe puts out. Paytm became a verb in India when people started saying, can you Paytm me, right? Sometimes it's new behaviors like TikTok or Snap, right? People were exchanging messages before Snap, but when they realized it's disappearing pictures, they started doing crazier things. TikTok makes anyone believe that they can be a movie star. So, Twitter is not actually a very efficient way of learning, right? It's like a very crowded, town square, right? But it kind of works. So when behaviors get established, then you can have very non-linear growth. And sometimes cost advantage can also matter. For example, building from India. Although this is now diminishing a lot, I think the India advantage in SaaS is very much under threat right now. So my point is, I think you all can appreciate these examples. Think about what will create non-linearity in your business, right? That will make it a better fit for venture capital. Otherwise, you may find that VC is not the right path for you. So hence, VCs focus a lot on large markets. Now, the large markets could be now or later, right? I like to frame markets as known or unknown markets. So if you have an AI agent that is going to help manage operations within dental clinics in the US. Now that's a known market, right? And we can sit down and discuss, okay, how many clinics, what kind of spend, how much might they pay, how much money are you saving them if they use your agents, hence what is the ROI for them. So we can come up with some math, and your math might be slightly different from mine, but we will generally understand each other because that's a known market. Sometimes it's an unknown market, right? Like the example of Uber I gave you was an unknown market because at that point, people did not appreciate that it would be a very permanent behavior change, and suddenly the market would be much larger than you realize. So my advice to founders is think about whether you're operating in a known market, and if you think that the market you're trying to create is not fully understood right now, that's great. That's okay. Just hold your hypothesis, and I think good VCs will take the risk. Another point about markets is, the slide that is the most common slide in pitch decks is the TAM, SAM, SOM slide. I'm sure all of you have seen it. It's 3 concentric circles. There's a big circle, a smaller circle, and a smaller circle in the inner circle, right? And this is the most common slide in pitch decks. For me personally, this is the most useless slide. I never look at that slide. And I'm not saying that other VCs may or may not look at that slide. Everyone may have a different style, and that's okay. But I believe that is not the most interesting slide when you're just starting out, because the best opportunities are not easy to size in the beginning, right? So my advice is to worry less about like this top-down calculation or looking at some consulting firm's report and saying, they say that this market will be worth 50 billion. So if I can get 1% of this market, I will be worth 500 million. I don't think this is as helpful as going bottom up, right? So instead of top down, go bottom up, or try to do both, right? What does bottom up mean? I would start by looking at one unit, one customer, one enterprise customer you have, or one consumer user you have, and try to understand, what will I do for him or her? What will I do for that company? How much of a ROI can they get by using my service, my agentic AI application? What will they hence pay, right? One of the things that Indian founders are really, really weak at historically is pricing, right? We tend to criminally underprice, and I think it comes from our middle class conditioning, right? So I think a lot of founders don't think hard about pricing. My advice to you would be, start from the value you're generating for the customer and then take as much of a share of that as you can, right? What people do is not that. They start to look at competition. So the most common answer I ask people, when I see a company and I ask the founder, why do you think this is the right price? They say, oh, this is big because the competition is charging this, and I actually will be a little bit lower than that. And my question is, if you are better, then why are you cheaper? Why do you have to be better and cheaper, right? If you are better, don't be cheaper. If you are cheaper, you don't have to be better necessarily, because you're already giving them value in terms of the saving. So I would urge you guys to think hard about how much value you're generating for your one customer, what is the price you believe you will extract, and then work bottom up to say how many such customers there are, right? And this may seem obvious, but I promise you, most founders are not doing this exercise correctly. Another way to look at it is, ask yourself, what does it take to get to 1 million? What does it take to get to 10 million? And what does it take to get to 100 million? Do this thinking exercise. You will be surprised by how few founders do this. And it's not that I care about the specific answer, because we don't know the answer yet, right? It's still early. But I care a lot about whether you as a founder are, remember what I said, obsession, right? If you're obsessively thinking about these details, it tells me that you are very likely to be a good business builder. And the next part is related to what I said about non-linearity, right? Disruption. What are your unique insights? I can promise you, I am not smart enough to come up with really original ideas. I think anything that I can think of as a business opportunity, someone has thought of, right? And today with LLMs, it is so easy, and it's almost like there is no excuse anymore, right? It's so easy for you to just learn what is out there. So one of the things I love to ask founders is, why doesn't this already exist, right? And I think if the founder has really gone into the depth of the problem, they have a very sharp answer to that. They're able to say very uniquely like what their insight is, why other products are broken. The best founders are able to go through at the product level and tell me, when you go through like the workflow, this is where most consumers are unhappy, this particular screen or this particular step, right? So that's the level of depth I would urge you to go to, right? To understand, why is it not already there, whatever you're creating? And you must have heard this idea of a 10x better, or delta 4 as it's called. Or you may have heard this idea of morphine versus vitamin, right? So let me just go over it for a minute. I think if something is just a little bit better, it's going to be very hard for it to be non-linear, right? As the way we described. So just think of yourself as a customer, right? Every single product that you, whether it is, again, I'm picking Uber just because we were talking about it, or if you go back, or maybe an LLM right now, or maybe it's a certain kind of travel app. whatever you have fallen in love with as a product has never been 5% better. It has felt 10 times better than the other products, right? So same thing. Now you're a founder. Are you providing something that's a nice to have vitamin, or are you solving some pain like morphine? And is what you're building like really significantly better, right? So push your thinking on that. You will be surprised by how very few founders go to that level of depth. I think the third thing is moats. Now, this is a very strange topic in today's day and age because there are no moats anymore. But the moats have to do with long term, why will other people not copy you or be as good, right? And so, today with AI right now, what we are seeing is, distribution is really, and data are the only real moats at this point, right? And even that we are learning a lot about. But my answer is always have a hypothesis. So I just got back from San Francisco the last month, and everywhere for about 6 weeks, the question that we were asking, or with all our startups, which we took for the program we do called Embark, a lot of people ask this question, well, if Gemini or Anthropic, Claude, Code can do this tomorrow, then how will you survive? Now, I think that's an interesting question, but if you're a founder struggling with that question, don't worry. No one knows. No one knows the answer. Have your hypothesis. Have a point of view which is clear. You don't have to prove to someone that you know how things will turn out in the next 5 to 10 years, but have a hypothesis about why you believe consumers will stick to your product, even if tomorrow an LLM or an extension of one of the LLMs is launching something in your vertical. But ultimately, right, the biggest bet at the first stage, and even up until Series A, I would say, right, the first 2 or 3 rounds of money is actually on the founder and the team. Only after Series B, C, it becomes about the numbers. So no matter what people tell you, trust me, largely it is on you as the founders, because business plans change, markets change, technologies change. The bet that we are making is on you, the founder. That founder doesn't the founder is the asset, and they will evolve and get better, right? That's the bet you're making. So, which is, as I mentioned, why the ambition, the obsession is what we really look for. And the best founders, especially in AI, are just learning machines, right? So one of the things that's happening is younger founders are actually currently succeeding more. Now, it may change in 2-3 years, but currently AI native younger founders are succeeding more than older SaaS founders because they are evolving faster, they iterate faster, they are starting from scratch and thinking about things in a very fresh way, right? So what matters in today's world is not experience, it is expertise, which are 2 very different things, right? Experience comes with age and time, but expertise can be built by just being a learning machine. Today, if you are a young founder in the audience and you're trying to create an agentic AI startup for some vertical and you have no experience in that domain, let's say you're trying to create something for the same example I used earlier, dentistry in the US, financial services in India, and let's say you don't have many years of domain experience, it's okay. As long as you are a learning machine, because with LLMs and with constantly talking to customers and iterating fast, you can just be as good as someone who has many more years. Now, of course, over time, you can hire more experienced folks to augment your team, right? But it's a great time to be a founder because unlike any other time in history, your gray hair don't matter as much as they used to. One more thing I will say about the team is, what we look for is this idea of having a telescope and a microscope. So what do I mean by that? The best founders I have come across have this unique ability of doing both. They're able to take a microscope view and they will be able to tell you what they're doing today, what their goals are for this week, how many customers they will have this month, what their revenue goal might be for the next quarter, right? They can take that microscope view, but they also can take a telescope view and say, in 3 years, I think vertical agentic AI will matter a lot, that Claude will not solve this problem. Here is why. And I am going to go after this segment first, and then in 2 or 3 years, I'll go after a second segment. That way of thinking is important. Even though their plans may not always work, they can always change gears, but they think like that, right? So having a telescope and microscope both at the same time is very important. Remember, when you start something, it's just an idea. Then it becomes a prototype. Then at some point, it is a full product. Then you turn it into a business, and over time, only a few companies like a Google can become a true platform, right? Platform in the sense that other people are building their business on top of your platform. So many things start at ideas, but very few things become large, game-changing platforms. But when we are investing as VCs, the way the good VCs are looking at this is, can I see that you as a founder are such a learning machine that you could evolve, right? I mean, Mark Zuckerberg, everyone's seen the movies, which is why I'm picking this example. College brat, right, in the about 20 years ago, and today maybe managing hundreds of thousands of people, right? So that's evolution, right? Which is what I think when we are investing early stage, of course, we don't know how the future will pan out, but we like to understand, is this a team that will scale? Before your product can scale, before your platform can scale, before your business can scale, the question we like to ask is, can the team scale, right? Can the team grow in their ability very quickly, non-linearly? So I hope I've given you like a lot of different perspectives on why a lot of VCs care about these things, and these are some very common mistakes that founders make when they are pitching, because they don't communicate these qualities, right? And they then get rejected, and then they think that their idea is bad. Actually, it may not be that your idea is bad. I think you may have just not created that crazy FOMO in the mind of the investor that they have to work with you. So it could be so if you think about these things a bit more carefully, you might have a lot more success with your fundraising journey. I want to also tell you that despite all of the things I said, there is a lot of like good news, which is that ultimately the great VCs don't think about what can go wrong. Like, I think, in my opinion, all that matters at the early stage is, focusing on what can go right. So again, I would go back to where I started, right? Which is, can you create a picture that if you succeed, you can be a very large company, right? So I ask two questions in my mind. If everything you are saying is true, let's say I believe every projection you have, will it be big enough? Will the world change? Will some industry change? Will some consumer behavior change? Will there be a massive amount of impact on India, on the world, right? If that is exciting, then the only other question is, are you the kind of founder who will go through anything to make it happen, right? And if the answer is yes and yes, then I will always invest. That's it. That's what it kind of comes down to, right? In the end, there is a lot of analysis, but the decision, at least for me, is always about these two questions in my mind, the feeling that I get after I spend a few hours with a founder. One of the questions that sometimes people have asked us is, what about solo founders versus teams? This is a side note, but we invest in both types of companies, solo founders and teams, right? But just as a data point, you are better off as a team. And that's not hard to understand. Venture capital backed startups go through a really long, hard journey. It's like riding a tiger every day. You are on a treadmill. You have to go fast. You have to achieve very big goals. So it's a lot of pressure. And many founders go through very tough times in their personal life during that journey. So I think having a co-founder emotionally, psychologically, is a huge factor to make sure the startup can succeed. That being said, there are always exceptions, and there are lots of solo founders who are forces of nature, and they can do just fine. But probability wise, your chances of creating a unicorn go down by 50% as a solo founder. So again, I am not pushing you to say you must be a team. I'm not pushing you either way, but on balance, it is better to be a team. Let me add some more thoughts, and then we'll cover specifically some questions and some thoughts on where AI is changing all of this, right? I think India is a great place, even though right now there is so much worry about why more great AI companies are not coming out of India, right? So when I came back from the US in 2013, there was about $2 billion of venture capital investment in India, right? This went up like crazy during COVID to almost reach 40 billion, 20 times. And then after COVID, of course, because the large, SoftBank kinds of rounds haven't happened, it is smaller, but it is still a very healthy industry, right? So if you look at what has happened in the last few years, India is about $12 to $14 billion in venture money in the early stage, which is still 7 to 8 times higher than 10 years ago, right? Or 12 years ago. So it's a lot of capital, and there is no dearth of capital for very promising companies. So if you hear this like, oh, it's almost impossible to raise venture money, or VCs are out of dry powder. No, not true. There's actually a fair bit of capital. And if you look at what is happening with AI, this is still taking shape in India. It has actually not really played out. If you look at the US, right, just between 2024 and 25, there's an 80% rise, almost doubling. The entire market almost doubling in 1 year, right? India is only up 20% in terms of the AI investing. This is as per Bain India's venture capital report. So my takeaway from this is, yes, there is no comparison when you compare San Francisco to Bangalore. We spend a lot of time taking our companies there. There is an epicenter effect. If you are building in AI, especially on the enterprise side, and you believe you want to be a global company, you probably should consider being in the US. And if you are, please talk to us. But if you're building something for the consumer market in India, there is an endless amount of opportunity. We haven't even seen the new AI focused companies. Education, health, travel, all agriculture, all of these, I believe these domains will see new consumer focused AI companies that will be built in India for India. There will also be companies built in India for the B2B market in India. We have many companies we've invested in around voice AI and the BFSI part, because that's where most of the activity right now is. And people actually underestimate that there is a lot of software spend in India. Lots of US companies, from Salesforce.com to Datadog to Mixpanel, they are doing $1 million contracts with Indian enterprises. But this money is actually going to the US, right? We don't have India-focused enterprise B2B players. So if you're working on something for the Indian market, don't be disheartened. You'll hear from a lot of people, oh, there is just no money in B2B in India. It is really hard, but there is money. And increasingly in the next decade, Indian enterprises will spend a lot of money on software and AI. So you will have a huge opportunity. But of course, there is no comparison when you look at the spending pool in the US. So if you are focused on the US market as a starting point, it is completely okay to say you need to consider spending time in San Francisco or moving to San Francisco or the Bay Area or anywhere else in the US for that matter. The point is to be close to your customer. That's the point. The point is not that if you show up in the US, you will suddenly get money. No. People are having this narrative that if you just show up in the Bay Area, there are angel investors who will fund you right away. And in India, VCs don't fund you. This is nonsense. There is no such thing. You don't get money just by showing up to the US, but if you are close to your customer and you get traction in the US, you will get more funding for sure. Now, again, I think just this is not surprising, and it's a dense slide, so I won't spend too much time. The mix is shifting, right? Of course, no surprise. You are seeing AI becoming a larger portion of where the money is going in India. I will tell you that it's still very early days. I think in the next 2 or 3 years, these numbers will look much bigger. And for us, for example, about 70 to 75% of what we are investing in is obviously AI native or AI first. I'm not saying AI enabled because every business is AI enabled. I'm speaking specifically about AI native businesses which have been thought of with a product or a workflow or a user in an AI native way. You know, India had one unicorn when I came back in Mobi. We have at least 100 now. There was 42 tech IPOs just last year. And there is no reason to believe that if we look at 2032, India may have 500 unicorns, maybe even higher. So there is a lot of excitement about the market in India, even though right now, you know, it feels a little depressing sometimes because we keep comparing it to what is happening in the US. If you focus on a very quick landscape, I think all of you are AI founders, so this is not news to you, but most of the money in India has gone towards the application side, right? Obviously, unfortunately, very few dollars going to foundational models or infra. We missed the whole wave, let's be honest. We didn't invest in the right areas as a country on the semis side, on the R&D side. And so the infra build out is very, very different from what is happening elsewhere in the US, for example. But on various application sides, on tooling, on developer tools, you know, everything around LLM ops to, you know, even now looking at the layers around the infrastructure, neo clouds and so on and so forth, neo labs that will create new models. I think that there is a lot of interest to look at those kinds of founders in India. And sometimes those companies might be built in India, or sometimes people like us might work with those founders to help them get to the US. So on the application side and on services, AI native services sides, I think there'll be a lot of funding to come. Let me see if there are any more questions at this point before we do the last section. Okay, so I will take 3 questions. Anshika Jain, what characteristics make Antler invest even when the traction is limited? So Anshika, I will only say this about Antler. For us, we are day zero investors. So our bread and butter is to invest when there is no traction. Because when there is traction, a lot of investors can look at it, right? We don't think that's that hard or as impactful, right? So we want to be the kind of investor who backs you before you have the data, before things are clear, right? And that's what we think true venture capital is. So 70-80% of our assessment is based on the founder. And I gave you some flavor of what we look for. I think we are just trying to partner with amazing people who want to build, who have the mindset of building large companies, right? And then of course we look at the space, the market that they're in to some extent, but largely it's just about the founder. So we spend a lot of time with the founders, understanding their history, understanding what they're doing in terms of discovering their problem, how much time are they spending with their potential customers. That's what we focus more on, because we believe that if we get that right, the traction will come. Sagar K asks, what is the typical deal construct which Antler has for startups? We now invest about 500K, but we might increase this in the future to even $1 million. So if you are raising anything in the range of 1 million or even slightly higher, we should be on your list to talk to. We believe we have a very friendly construct, which typically starts with around 10% or so ownership in the current model. We also come with almost $500,000 to $1 million of AI native perks, which are through our partnerships with various cloud providers, GPU providers, etc. We also have a lot of downstream capital. So when we invest $500,000 in a company, we take the view that we could invest $20-30 million in the same company through other vehicles we have, which are at Series A, Series B, etc. So we want to not just be a one check writer, we want to be part of your journey for many, many years. Jack Praveen Raj Ilango is asking, as a founder building an AI startup in India who used to live in San Francisco, has direct access to talent pools in San Francisco and the Bay Area, how could an Antler's Embark program help me accelerate my startup journey? Well, thanks for asking that. We have now done Embark 3 times with almost 40 startups, and it's been mind-blowing what we've heard from founders about what they have found valuable. So instead of me selling anything, I would just say that we listen to what these founders are saying. And what they have told us is that the intensity that we create for 1 to 2 months by working with them in person in San Francisco has made their mindset shift very, very rapid, right? So even if you have lived in San Francisco, if you haven't spent time there recently, the mindset shift you need to create is really hard right now, right? So think of the benchmarks that are expected right now. Hyperscaling in the AI age is a completely different mindset. So we're spending a lot of time making hundreds of connections for each founder, bringing in lots of AI founders, operators, investors, and in 3-4 weeks, making sure that you are having 100 solid conversations, right? So this has helped founders get to traction. About 75-80% of these startups went to the US with zero US traction, and within a few months, they have some US traction, which means they have a design customer in the US, they may have revenue in the US. And that's the key, because if you are focused on the US market, unfortunately, investors only care about US traction. So unfortunately, if you have $1 million of revenue in India and you go to the US, unfortunately, investors by and large will completely discount that, and they will ask you, who are your US customers? Because that's what they can understand better. So it's a combination of mindset shift, the GTM traction, and feeling at home and finding your community in the Bay Area very quickly. Okay, I think let me move to the last part, which is what AI is changing and what it is not yet. So I think I don't have to tell you that the world is going through the biggest boom ever. And this is just a market that keeps expanding. The numbers in capital expenditure, CapEx, are insane. Whether you look at Google or any other large tech company, the amount of money that's going, I think something like the majority of economic growth in the US right now is CapEx around AI data centers, right? So this is the scale we are talking about. This is bigger than the dot-com boom times. This is bigger than the gold rush of the 1850s. And you know, this, I think, while I am not going to predict what's going to happen in the next 6 months or 12 months, but it looks like this is here to stay for a lot longer, because organizations are actually seeing ROI. They are seeing the return on the investments that they're making. If they were not seeing the return, then you could question that they will not keep investing into the CapEx. But currently, at least, I know there's a lot of news in the last 2 or 3 weeks around token maxing and the bills that some of the large companies are seeing. That's a valid concern. And of course, open source costs are 90% lower. So you could argue that some of that shift will happen. But it looks like for the next few years, or maybe next 18 months to 24 months, it doesn't seem like the party is stopping anytime soon. The crazy thing is how quickly companies are becoming large. So time to 1 million users, right? Netflix took 3.5 years, and Netflix at that time was a success, crazy success, right? OpenAI took 5 days. If you look at not just users but revenue, time to $100 million of revenue, which used to take 7-8 years for some of the best companies like Shopify or Twilio. Of course, with we have a portfolio company, Lovable. And of course, there are many other names from Cursor to Anthropic, and even the video side, Midjourney, etc. I think you've all seen these numbers. But it is crazy how quickly this is happening. It's not taking years, it's taking months. So as a founder now, that is the new benchmark, right? Which is why if you're an AI native founder, on one hand, it is super exciting because you don't have to wait for 5 years to see scale. On the other hand, it's super high pressure because if you don't have crazy growth right now, after you raise some money, or if your product is not seeing a crazy traction quickly, unfortunately, it's received less well by the market. And just to give you a sense of comparison to cloud, it used to take the best companies 7 years in cloud. For the AI stars, for initially the ones that took off, it took 4 years. But for the superstars that are emerging now, and I won't name specific companies, but you even have examples like Immersion out of our ecosystem, right? Mukund, that was a very good friend of ours, that scaled to 100 million in 9 months. So it is crazy what is happening right now. I'm so envious of all of you who are founders. So what is happening is that this is also reflecting in valuation, right? Because if you grow that fast, you obviously get crazy valuations. So what this means is that everything is happening faster. So you as a founder, when you think about capital, so some of you might have these questions like, how should you think about your first check? So there are different schools of thought. Some people might feel that today you don't have to raise venture money because you can just take a small check from angels, and you can use AI tools to get revenue, and you can become profitable, and you may never need to raise venture capital. And my answer to that is, yeah, probably that's going to happen with a number of companies. So that's one path, right? Just don't need to raise venture capital. But typically, those companies are also not necessarily going to be very large, but they could be very profitable for you as a founder. Then there are others who might say that you should raise one round of venture capital. And that's called seed strapping in the US, right? You raise one seed round and then you get on this crazy growth and you'd never need to hire enough employees. So you could be a large company. Potentially that could be a path. And we feel like with Antler, we are trying to be very supportive of founders who want to think like that. There are other extreme cases where, now there is potentially like people talk about, can there be $1 billion company with one person? Yeah, potentially this can happen now, but I think that will still be very, very rare because people don't buy products, they buy the experience. And typically as you grow, customers are wanting much more than just a product, right? So you need to build layers around it, and usually you will still need to grow your team. So I think there are more different. Earlier it was only like bootstrapping and venture capital. Now there are some other options, perhaps seed strapping, which means just do one round of venture capital, being AI native and growing without venture capital. But there is another problem, right? Which is that distribution is really the moat now. So you could get initial traction without venture capital, but what you have to be careful about is if you don't have the kind of speed such that you become very, very large, you may also have no moats. And if you need to grow distribution to that extent, you probably need venture capital, right? Because it's going to be very hard for a typical company to grow into that scale without venture capital. So if you have to invest in that growth, then venture capital is a good fit for you. But coming back, it's taking less time for companies to be large. It used to take forever to be a $50 billion company, right? I'm old enough to know that this used to take a quarter of a century for the best companies, right? And now it could be less than a decade. So it's an amazing time to be a founder. Another thing that is happening is revenue per employee is becoming an interesting metric, right? Which earlier we didn't care as much about, and that's because as the marginal cost of intelligence is going to zero, AI is reducing the time from idea to MVP, the GTM. So what you're seeing is that now you start with an idea, you build some AI leverage, and you don't need to hire employees that quickly. So the revenue per employee is growing very, very rapidly. And what we are seeing is, for sure, this is not my suggestion for you to hire less or more. Please do what's right for you. But when we look at the data, we are seeing that team sizes are reducing. Bad news for the headhunting industry. Team sizes at every stage are slightly smaller than they were earlier. And founders are putting off hiring their initial employees. So one of the things that's for sure is the case that is today, when you raise a seed round from us or anywhere else, you should definitely try to keep it to a very small team and try to see how far that takes you before you decide on your longer term path. So last thing I will mention is this idea, which is specific to SaaS and B2B, is, again, it may seem unfair, but it's also exciting, and I want all of you to embrace this. It's a new world, and the framework is now growth at crazy speeds. So we used to have this thing called T2D3, triple, triple, double, 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 right? Which is a SaaS company, in the first few years, you should try to triple, triple, and then double, double, double. Such that, so it's 3 times 3, 9 times 8. So that would be 72 times in 5 years, right? Now the expectation is quadruple, quadruple, triple, 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 right? So it's just a massive reset of how fast people expect you to grow. But again, I think the beauty of it is, if you have something that's game-changing, AI native as a workflow, every enterprise in the world is right now opening up budgets to try to experiment. So it's becoming, the sales cycles are actually shrinking in the enterprise world, which is great news. You just have to make sure you think ahead in terms of sustainability, right? But that's something for the next phase of your company. So I went over a lot of material today. I hope most of this was relevant, and I hope some of this was very helpful to you. I will close this session with any final questions. Okay, Antler residency. So I think, what I wanted to leave you with is some thoughts on how, because there have been a lot of questions from the audience about Antler residency, it seems. We are not a traditional accelerator or incubator. We invest very quickly as well in companies. You don't have to come spend 3 months going through a specific program. We deal with solo founders. If you are looking for a co-founder, we can help you through our Before Day Zero community. But if you are a team with a clear idea and you don't have any traction, that's fine. That's our sweet spot. We will spend time with you. Sometimes it's 2 weeks, sometimes it's a month, and we will invest in just you and your idea. We do not need traction or a product. So that's the gist of what we do. And in that process, hundreds of founders have told us that they found it gave them a lot of clarity, even if we didn't invest in you. So that's our genuine intent, is to help the ecosystem and help founders like you by helping you get clarity around venture scalability and the problem you're solving, right? In terms of the investment, we invest, if you go through the process for the residency, we often invest directly in other rounds as well. And if you are trying to go to the US, we have Embark. It's antler.co/embark, EMBARK, which is where you can find a lot of information about the money we invest, but also all the work we do. As I said, our goal is to get any founder through Embark embedded in the Bay Area ecosystem with 1 month or less, with hundreds of connections, right? And one other question that's come up is, Nitin, from where you sit, what is the biggest mistake founders make when they apply to Antler? Well, I think probably just summing up this session, right? Not thinking clearly about why they are building this business for the next 10 years. Having that clarity is, sometimes a lot of people think that they want to try a startup. That's not what is going to work. These startups only work when you have that crazy commitment and obsession. That's one. And I think second is not thinking through the venture scalability part, which I hopefully covered for you in some detail today, right? Not thinking through the why it will be a large outcome in the end, not just what is happening right now. I'll pause there. Thank you for your time. Thank you for listening. I really enjoyed talking to you. I wish we had more time to interact, but I'm going to hand it over back to my colleague.
What an incredible, unfiltered way to wrap up our series. A massive thank you to Nitin for pulling back the curtain on VC mechanics, and to the entire Google for Startups team for making this happen. To our online cohort of over 1,000 startups, congratulations. We have officially completed phase 1 of the Google for Startups Immersion program. Over the course of this cohort, you have gone from vibe coding to mastering autonomous agent frameworks, serverless cloud deployment, and finally understanding true venture scale strategy. You should be incredibly proud of the progress. Before we officially log off, here are your immediate next steps. The resource vault. You don't need to screenshot everything. All the links, toolkits mentioned on today's call will hit your inbox via email within the next few hours. The 60-second feedback. Please take a minute to fill out the feedback survey on your screen right now. Your inputs directly shape how we design future cohorts. It takes less than a minute and we read every single one. Phase 2 shortlist. If you made the shortlist for Phase 2 based on the application submitted yesterday, you will hear from the Google team by June 15th. We hope to see many of you live at the Google Bangalore office at the end of this month. Thank you all for your incredible energy, your code, and your commitment over the last few weeks. Now go build the future. Have a great evening, everyone.